Assalamualaikum warahmatullahi wabarakatuh and very good day to my lecturer and my fellow friends. My name is Mohamad Farizuan bin ABDUL. I am from class DBC 2423A. In this video, I would like to present about mergers and acquisition. So we look table of contents. First, I will explain about the definition of mergers. Second, forms of takeovers. Next, means of acquisition, and then type of acquisition, and lastly, the defensive tactics. Okay, we go to the page. Definition of mergers. What is mergers? A merger is combine two businesses into one, either by closing the old businesses and forming a new one, or by one firm absorbing the other. In other way, two or more businesses are merged into one. When two organizations agree to join and form one organization, it will be termed as merged. It can be seen as a decision taken by two equals. When two organizations combines, the shareholders' share in the previous firm usually are swapped for an equal number of shares in the new organization. They have a few advantages when the two organizations are merged. For example, it can lower costs, raise profits, overcome existing challenges, reduce weaknesses, and improve shareholder value for both sets of shareholders. Next, we go to the forms of takeover. What is takeover? Takeover is a sort of transaction in which the bidding firm buys the target firm with or without the two firms' management agreeing to it. When one firm successfully bids to take control of or buy another, it is called a takeover. There have four forms of takeovers. Firstly is friendly takeovers. A friendly takeover happens when the board of directors of both the target and acquirer corporation discuss and approve the offer, resulting in a win-win situation for both. The buyer contacts the target company's management, discusses its plans, and makes an offer. If the management accepts the offer, the company shareholders are advised to do so as well. For example, a friendly takeover is Facebook purchase WhatsApp with the $19 billion. Next is a hostile takeovers. A hostile takeover happens when an acquiring firm attempts to acquire another firm, the target business. But the target firm board of directors does not want to be purchased by or merged with another company, or the bid price presented is unacceptable. The target company may reject a bid if it considers the offer to undermine its prospect and potential. For example, to these takeovers is Kraft Foods and Cadbury. Kraft Foods want to buy Cadbury, the world's largest candy firms, in September 2009. At the first, Sir Roger Carr's Cadbury chairman was rejected Kraft offer with a 16.3 billion, but Kraft remained undeterred, and in 2010 it boosted their offer to 19.6 billion, and Cadbury eventually gave in and the two firms complete the merger in March 2010. Besides, another form of takeovers is a reverse takeover. When a private corporation buys a public corporation, it is known as a reverse takeover. The fundamental motivation for reverse takeovers is acquiring listing status without going through an initial public offering. In other words, in a reverse takeover, the private purchasing business accept an already listed firm to become a public corporation. So for the example to reverse takeover is Burger King and Shell firms. Burger King was absorbed by Justice Holding, a publicly traded Shell firm, in a reverse merger in 2012. It acquired only 18 months after the fast food chain was purchased out by 3G Capital in 2010 and went private. Burger King become a public corporation again after a merger between Justice Holding and 3G Capital. Lastly, a backflip takeover. A backflip takeover occurs when the acquirer becomes the target company subsidiary. Because the target company survive and the purchased business become a subsidiary of the merged firm. The takeover is referred to as a backflip. The acquiring company may make a backflip takeover bid to the advantage of the target, better brand recognition, or any other significant market advantage. For example, Continental Airlines was purchased by Texas Air Corporation in 1982 because Continental Airlines was far more well known than the Texas Air Corporation. It was decided to preserve the latest name. And now we go to the next page, means of acquisitions. An acquisitions occurs when one firm buys the majority or all of the shares of another company to take control of that firm. Acquisitions may be negotiated between the two firms, including their boards of directors and essential shareholders, depending on the circumstance. Both corporations are likely to view this transaction as a positive step forward in this situation. If the target firm isn't on board, the deal may be still go through, but it's more challenging. Okay, this is type of acquisitions. They have four type of acquisition. Firstly is a horizontal acquisition. Is when a company acquires another company in the same business, industry or sector that is a competitor. A real life example of the same would be Facebook get WhatsApp. WhatsApp still exists with the its brand. However, it is now owned by Facebook. In the classification of the purpose of the acquisition, we can see to explain more about this transaction. Facebook and WhatsApp are both in the same industry, social media. However, the acquisition resulted in both leveraging their respective expertise. Secondly is vertical acquisition. In the same sector, two businesses join forces but at separate points in the supply chain. By streamlining logistics, integrating employees, and maybe shortening product time to market, they become more vertically integrated. A vertical merger would be a closed store purchasing a garment manufacturing firms. Thirdly is conglomerate acquisition. When a corporation buys another firm in a completely different industry, sector or business, it is known as a merger. It is mainly done for the sake of diversity. A corporation in the food business buying a firm in the apparel business in one example of this. Hamleys, a toys goods manufacturer, was recently acquired by Reliance Industry. Reliance is a large conglomerate that wants to grow into the toy sector. Thus, it purchased by transferred 100% control to itself. Lastly, for the type of acquisition is conglomerate acquisition. Conglomerate acquisition occurs when two organizations execute different but related activities for the same consumer base to join forces. A bank buying a specialty financial service company, such as an insurance firm or a loan provider, is an example of this type of purchase. The acquiring company in this example, the bank might incorporate the target firm's product line and client base into their own as well as cross-sell their item. So we go to the last slide for this presentation. Okay, this is the defensive tactics. A defensive tactics, also known as a defensive mechanism, is a combination of process followed by a target firm to avoid a hostile takeover. There are many defensive tactics that companies can use to avoid acquisition. Firstly is divestitures. During a divestiture, a company sell asset or a division to the highest bidder and get cash, which is then reinvested in new assets, paid to stockholders as dividends, or used to buy back shares. By doing so, the target company adds value to its shareholders while making the company less appealing to potential acquirers. Next one is a poison pill. Borrowing under condition that necessitates prompt repayment of all loans if the company is bought is a poison pill that can often equate to economic suicide to escape a takeover. Second, the target firm shareholder provide the ability to purchase shares in the combined business at a reduced price if another business acquires control. After that is White Squire. In White Squire, a friend of the current management is urged to buy enough of the target company's stock to prevent a hostile takeover, making it nearly hard for the acquirer. Other strategies include attempting to persuade the target company's shareholders that the offered price is too low. Besides, spin-off. A spin-off occurs when a company separates asset or a division and issue new stock with a claim on that business component. Existing stockholders in the company get this share in proportion to their previous holding, and they have the option to keep them or sell them in the market. Finally is split ups. The firm breaks into distinct lines of business. It distributes share in this business line to the original stockholders in proportion to their initial ownership in the firm in a split up, which may be considered an extended form of a spin-off. Split up is similar to a spin-off in that it produces the new shares in an undervalued business line. However, current stockholders are offered the opportunity to exchange their parent company stock for these new shares, changing the proportionate ownership in the new structure and making acquisition harder. Okay, so that's all for me. I hope everyone can understand about the mergers and acquisitions. Thank you for watching this video. Assalamualaikum.